All right, everybody, welcome back to the Cashflow Chronicles, October 7th, 2025. Appreciate everybody being here. We have a good episode. Chris and I chatted behind the scenes, got a few opportunities to talk about multiple topics. We have Oracle lined up. We have, and he just quit midstream again. Fed cut rates and Verizon again. And then we can talk about year to date or the previous 12-month performance on the portfolio, because it has been quite some time since we have done so. Let's just run down the stocks that we kind of keep track of, mostly on the channel. Everything still seems to be rather up. But before we run through that, of course, if you haven't already, please subscribe. It allows you to participate in the chat. And if you feel free to, and we feel warranted, please consider becoming a member. Apple, $255.83, Amazon, $221, Dutch Bros, 47. That one stuck out to me. Google, $245, Palantir, $182. Rocket Lab all-time highs at $62.37. SPY, $670. The Q604, Bitcoin, 121,897, retracing from its all-time highs at 125. Oil still in the $62 range, and Henry Hub gas at $3.50. Mr. Patel, how are you doing today?
Good, man. Just I slept today finally. I got some really good sleeping in the morning. Anytime the market is like super either green or super red, I'd like to just sleep. Like when the market's flat, I tend to I'm like, what's going on? Like, what's the news out right now? But when it's usually green or red, it's like, all right, let me just pass out. The market's doing what it's supposed to do. So
interesting. So we have a couple topics. So I don't know if you want to preface any of them. I got some videos pulled up. I don't know if you want to start with those and then
your baby
talk
blue
about them
eyes
after.
Your baby blue eyes are looking extra blue today. What's going on, Matt? What's going on?
Nothing. Actually, I'm in a pretty bad mood, which actually I was thinking the same. I was
what?
Like, I don't know if this shirt, it might be the shirt. I don't know.
You're in a bad mood? Why?
I don't know. It's not actually bad. I mean, I'm not actually in a bad situation or anything like that. I don't know. I'm just being a grumpy gills for no reason.
Did you not eat today? What's going on, man? That's the only
time
I
actually did. I had some boneless wings. They were delicious.
Okay, all right. Well, I hope your day gets better, sir.
No, it wasn't a bad day or anything. I'm just being a grumpy gills. Everything's fine. I'm just being a grumpy gills. Yeah, everything's perfectly fine.
What was the question? Sorry, I got lost in your blue eyes.
Do you want to preface anything before we get into Oracle or the Fed cuts or Verizon?
Gotcha. So I think one of the things that I wanted to just mention today was the market, even with the slightest bit of news that the AI bubble has run its course, is now reacting very violently, right? So there's definitely a lot of fear in the market about an AI bubble, and now you can kind of see all the mainstream talking heads coming online and saying the same thing. So the amount of people that are stoking fear in this market is super high. And I got called out today too, because I'm getting worried. So I posted something on X about, all of these companies, they're coming out and starting to do capital raises at the money. And someone called me out and said, oh, look, you're always trying to call tops. I'm like, man, that's my job to try to call tops. It's what I do, and a lot of times they are local tops that are basically just, 5 to 10% correction. It doesn't have to be every time doesn't have to be a 2008 level event. And, it's just about positioning your portfolio to mitigate some of those downsides. So I think today a good talking point is going to be, I think for 2026, how to position ourselves defensively against this current market. So if you are worried, what are some of the steps you can take? Where can you rotate to get value? As an example, I rotated a good amount of money into the healthcare stocks, and they've been ripping. They've been doing really well. Did we have any in our portfolio now?
I never ended up buying any. We do have a little bit of Oscar, which is up about 30%. But other than that, do we have anything else? Whoops. And there, let me see. just Oscar. Yeah.
Yeah. So like if you look at the other two that have been doing really well, like Elevance and Molina, both of them have been recovering based on the ACA news that, there's probably what is that thing called? A deal that's to be made. So if you just look at that, that's a pretty insane run. And it's a sector that a lot of people were ignoring, so it's one of those things where you don't need to be in every major AI play in order to make really good money in the market. So sometimes you just need to rotate defensively. And I think that's the key to investing, right? Like you have to look for opportunities where other people can't see them. Because if you follow everyone along, then you're basically generating whatever the alpha the market is willing to give you, right? So sometimes having a little bit of a contrarian take also helps. Another one, a good one to look at is Centene CNC. So look at that. Pretty insane, So I think a lot of times we get into this zone of, AI stocks, those are the hottest. And so everyone wants to be in them. And sometimes you get caught in like, let's say the thesis doesn't necessarily play out right away. Like an example of that would be like Novo Nordisk, right? Like Novo is pretty much a lag
it's
right
one
now.
I've been looking at it too. Yeah.
So you can see that it's definitely off of its August lows and it's starting to make a, sort of a comeback, but there's still a lot of room for it to go. Its business metrics are improving. Well, they should be improving in the next couple of quarters, but in terms of like their core business, they're trying to rejigger things to make sure they're in the right path going forward. So I wonder if there's any way you can like brighten up your screen, because it just looks really, really dark, like the thing, because I know we're going to be using Webull for presentations. So if you go to your top left and you go to layouts, or not layouts, sorry. Where was it? The window thing. So this way you can see it, like,
Maybe
I don't know.
You should share.
Yeah, let me see if I can share and see if it looks better.
I also don't want any proprietary information.
Yeah, I got you. Okay. Now we'll let the chat be the judge. So let me just bring up this thing right here. Okay, chat, which one looks better? Does this one look better? Let me see. Show layers, chart settings, and you can actually change them right here. Appearance and custom background. We could put it to white. Is that showing better? Okay. There we go. I think that looks a little bit clearer for everyone to see.
Yeah, there you go.
Right? So
what'd you do?
Yeah.
Chart settings?
Yeah, I went to chart settings. Let me just go to it. So chart settings right
background.
Here. Yeah, the custom background, and you could put it to like gray, whichever one, like black. Like this is like true black. I think that might be easier. And even the lines and stuff, you can get rid of the grid lines if you want. You can keep the grid lines. Background color, solid, interval, symbols. Yeah. Flashing light. I don't know what this is, but yeah, we'll figure this stuff out, make it look a little bit easier for everyone, just to, so that when we do our presentations and stuff, it's easier for people to see. But yeah, you can see here that the healthcare stocks have basically been on a nice recovery path, and they've still got a long way to go. So if you look pre Big Beautiful Bill, a lot of these companies have fallen off and they've started to kind of make a recovery run. But I will say this, the RSIs are starting to get a little high. So it's not like I would jump in with options here. Probably just do straight stock. Options was right here. That's when you had this perfect opportunity to buy. So same thing with Elevance. If you look at Elevance, we did this whole deep dive on Elevance before about how they're kind of probably
what on your and Sam's channel, or
no, we did on this one. No, we actually spoke about Elevance last time.
I mean, we didn't do a big deep dive, but we did, like, we talked about it for a couple minutes. But
yeah, well, the thing with Elevance, remember I said Elevance was gonna do margin improvement. We did this whole thing, so that's basically
okay,
the theme of it. So
so
Elevance is starting to kind of come come back to some level of normalcy, but now it's gotten to the point where it's a little bit overbought, right? So this is not a place where I would be adding a lot of options to it. You could probably buy some stock and be okay with it, but on like a 1 year time frame, the RSI is already in the 70s, so just being cautious. But yeah, like, so one of the opportunities that I think I'm seeing right now that I like anyway, and I've had this one and I've traded it a couple of times before with some great effect, is let me see, GLP-1 savvy portfolio, preferred income. Where is it? Picture. Okay, it is, believe it or not, Verizon. I know a lot of people are going to say, well, Verizon, like, why would you want to be in a telco? And I'm like, well, next year I'm going to be positioning my portfolio to be a little bit more defensive. And right now I think is a good time to load up on quality companies who have really strong dividend profiles and be able to kind of take advantage of that. So, we could talk about that like later today, but is there anything else you wanted to cover?
Am I on mute?
No, you're good.
Okay. Sorry, I was just modding some people. We have Oracle, we have the Fed cut. I have some videos lined up for that. We have the Verizon CEO swap. I assume that's what the news you wanted to talk about for Verizon.
Yeah,
you said Verizon.
Yeah.
Okay. And then I have some Rocket Lab stuff if we have enough time. I know it's all-time highs. I kind of am invested in the stock. It's in our portfolio, so if we get time, maybe. But I mean, I don't want to beat a dead horse because I already talk about it once a week. So so yeah, it's up to you. We don't have to. That'll be on the back end. But where do you want to start? We have some good videos from CNBC and stuff lined up, so we can start there if you're prepared.
Okay, yeah. So go ahead. Share the Oracle one about the news that Oracle came up with and probably helped crash the market a little bit.
Which one? Well, wrong one, I think. That's the wrong one. Where is it at? There it is.
Because it's an interesting developing story.
Where is the volume?
And you can see ago, these shares took a dip by about 5%. The information is out with a story today, which says the following. I'm quoting directly from this story, and this is the reason why the stock is lower. Internal documents show the fast-growing cloud business has had razor-thin gross profit margins in the past year or so, lower than what many equity analysts have estimated. That could raise questions about whether the AI cloud expansions undertaken by Oracle and its rivals will affect profitability and sustain investors' expectations. So this really speaks to what you're talking about. But here we have, according to the information, and we're continuing to work on this, and we'll try and get you more in just a little bit. Nebius is down on this. You're looking at related names, really at a time where we are, as an investor class, sort of really trying to get an idea where we are. Whether there's a bubble, whether there's been too much spend, whether there's been too much speculation on what the spend will result in. And at least this story right now about Oracle is sending those shares lower. There's CoreWeave, which took a move lower on that as well. Josh, I didn't mean to interrupt you, but I don't want to sit on that as we watch that stock go down.
I appreciate you bringing that into the conversation because that is exactly what it looks like when some air is let out of these types of bubbles. And the main point that I wanted to make, and I'll make it right now very briefly, so I know we have a lot to get to, is that not every bubble ends in a 2000 to 2002 style secular bear market that takes the S&P down 57%. That's not how most of the time these things end. Most of the time, you'll just see certain names blow up. You'll see valuations contract. You'll see a couple of years of sluggish share price growth as we digest some of the excess. It doesn't always have to be the NASDAQ down 85%. People think there's this binary thing where either the market triples or gets cut in half. And most of market history says otherwise. It's okay if certain people are paying certain high multiples for certain stocks, and then that ends. It doesn't mean all of us have to go through Great Depression Part 2. So there's room to say a lot of this activity is justified, while you can also say there are some people doing some insane things.
Yeah.
It'll all come out in the wash, and I think investors will be okay.
Joe, you got shares of Oracle. Jim, you do too. But this is about how much money Oracle is generating from the rental of its servers that are powered by NVIDIA chips, and that the gross margins are perhaps lower, according to the information, than some analysts have modeled in, which is one of the reasons, obviously, there's been so much optimism around this name. If you broaden this chart out, guys, if you could, back to around the earnings report, and there it is. I mean, you can see that the move higher there on the left-hand side of your chart. Remember, the stock exploded higher the day that this company reported earnings. So,
a short drive from Houston, the Texas coast's best-kept secret is the opportunity.
We could probably just cut it there. But interesting sort of piece, right? I mean, just from what I'm hearing, right, from this particular piece, this is something that you were always kind of hesitant about 6 months to a year ago, about at what point do you see these margins shrink? At what point do you start to see people have too much of these chips being ordered? At what point do you have to see NVIDIA have to cut back on their prices? Because obviously NVIDIA is not the one at the moment that's in trouble here, obviously, with the revenues that are continuing to go up, the growth rate. But at some point, as you're seeing here, NVIDIA is going to have to take a hit on their margins to be able to make it comparable for Oracle to be able to make money. And then you're going to see this problem exacerbate and follow and trickle down into other places. So I'm curious to hear your thoughts. That's how I'm interpreting it, right? You're seeing it right now in Oracle, you're seeing it in other companies now, but that obviously has to trickle through. And I like what Downtown Josh Brown had to say about, you don't see this all rapidly at once. You can see it, right? You can see it like how it happened in 2021 with some of these speculative stocks, where some of the SPAC stocks, they literally just had nothing to show for. They dropped 70 to 80%. There was literally nothing of substance there. And they went basically to zero. And some of them have now since recovered because some of them did have substance. But I just remember Facebook for a long time was below $100, and you could have picked it up, during the pandemic for under $100, and actually 2022 for under $100. And so you think about how long it stayed under $100 when it IPO'd at 40 back in 2014, I think it was 2015 timeframe, and how long it took to get to 100, and how long it stagnated at that point until it really started to kind of take off. So I thought that was pretty interesting observation from JB.
For everyone giving us shit about YouTube Premium in the chat, well, first of all, I did not share that video. And two, even if I did, it probably would have showed the ads anyway, because I have a business YouTube account and a personal YouTube account. And for some reason, they're not linked. So sometimes you'll see an ad, but usually when I'm browsing, I don't have ads. But I think Oracle is a very unique case in this, that, let me just share the screen. One of the things that's always been worrying is when it comes to Oracle, their financial health, they're in a good place in terms of like cash flow, right? So if you look at their total revenue's been, nice, steady increases over time. So it's not like they're dying business, and the CAGR is about 5%, right? So it's not the fastest growing thing on the planet. So that's number one, but it's not slowing down, which is also good. The challenge that you run into with Oracle, though, is that if you look at their debt levels, unlike the other hyperscalers who are pretty comfortable with their debt, Oracle actually has a pretty good amount of long-term debt. Where's their total long-term debt? Right here. So if you look at their long-term debt, they've got $82 billion in long-term debt. Okay. And then when you go against its cash flows and you do like a net debt to EBITDA. So sorry, sometimes this is a little slow. Enterprise value. Where's the financial health? Right here. Long-term debt to capitalization, net debt to EBITDA. Okay. So net debt to EBITDA, you can see, let me just hide this real quick. It's not bad, but it's not good either. So a good net debt to EBITDA is roughly like below 3 for like investment grade. But sometimes they've, if they've done like a big acquisition, they financed it a lot of debt via debt. And so the level of debt that's here is here. So it doesn't let Oracle spend as much money as, let's say, Google or Microsoft or Amazon, who have a lot more in cash versus their debt. So this is something to just keep in mind with regards to Oracle. So a lot of the stuff that we see with Oracle, it's like, oh, Oracle's investing all of this money in data centers and everything else. What they are also doing is taking a risk in this part of their business. So unlike the others, which can be, which they can let AI be like a loss leader for a prolonged period of time, Oracle doesn't have that same luxury. So not to say that, if you just look at the total debt amount too, that's not probably the only thing you want to look at as a good investor. Like one of the things that we actually were talking about the other day, we were just kind of messing around with Webull, and one of the things that they have is like the related bonds. So you can actually see what the total cost of the bonds are for Oracle, right? So let's say you wanted to buy some Oracle debt, you can buy these that are right here. So one of the things I'm actually eventually going to work on with some people that I've spoken to on Patreon is creating a custom debt modeling application where you can kind of just plug in like let's say Oracle, right? And basically it'll give you all the maturity dates, like pretty much like it'll do like a rundown of how much debt is coming due by every single every year, and then you can kind of drill down which debt is which debt is callable, which one is not, and all of those things. So the data is out there. It's just I haven't seen any platforms do a really good job of just
Yeah, I haven't seen any either.
right. So
And I would
and
love
it's
it. Like I love it when even the companies rarely do it, right? Like I love it in
Mhm.
an investor deck when they're like, here's our debt schedule, and you see like the bar charts. I'm like, thank you. Like I love that because it
Yeah,
lets you know like when are these things coming due? Like otherwise you have to literally scavenge. Like this, when you showed me this the other like last week, I was like,
yeah,
this is beautiful because this is the easiest place I've ever seen it available.
yeah.
Every time else I've had to scavenge like a 10K or a 10Q to be able to find it and have to go to their debt schedule. And so seeing this is beautiful. And not only that, but the fact that you get to see the liquidity of it is pretty
Yeah.
interesting as well.
Yeah, it's nice too. If you just want to, for anyone who wants to buy corporate debt or try to understand how corporate debt works, this is pretty good way to do it. You can buy it directly from Webull actually now, which is kind of crazy because I haven't met any like retail brokerages like Robinhood and everyone have this. So you can kind of just put in the order. Most of them are going to be limit orders, but anyone who's trying to get into fixed income, it's a nice little nifty thing to look at. I haven't used it personally. I have a bond guy that I just call from Fidelity, where I just will be like, "Hey, listen, I'm trying to get into this new issuance," because usually, like, new issuance is where there's opportunity sometimes. But you can see here, at one point, this 5.35375% coupon that matures in 2040, its current yield right now is, and you could actually do it, it's currently 5.225%. So when it comes to something like fixed income, you kind of have to know the tax implications too. Like the interest payments that you get are going to be done on an ordinary income basis. So if you're like a high, if you're a high earner, this is not probably good for you because you're going to end up paying 35% of it in taxes. So it's like, oh, I just got $100,000, but 35,000 went to taxes. What's the freaking point? And then if you live in a high tax state, then you're going to pay them too. So then it's like your yield is not even 5.35%. It's probably much lower. So for that reason, you kind of have to know how to like work on the tax part of it. Um, but there's opportunities here. Right now, we are in a higher rate environment, so a 5.37375% yield is not very attractive. Well, it's attractive, but it's not like, oh my God, like nothing to die over. But if you remember during COVID, interest rates had kind of sunk all the way to the lows, and at the time, the same bond was trading for $143
because
because
this
you're
was
getting
issued in 2011.
Yep.
So, and it was probably issued at $100 par value. So, so basically what the saying is to be able to make it make sense. I mean, it skyrocketed in price so that the yield went all the way down.
Yep. And you can see here whether it's callable or not. Like these are things that, like, if one day maybe we'll do an entire what are they called? Like a video on what callable, non-callable, like what to look for in a bond, like what the credit ratings they mean, what's yield to maturity versus, versus
semi-annual. F that.
Yeah.
Most are though.
Yeah, most bonds are semi-annual. Like you'll see very rarely you'll see anything that's a quarterly. So, but it's still, like I said, a pretty good return. But the point is, Oracle has a good amount of debt. All right. So for anyone wondering, like, like how do you analyze this? You really have to look at this holistically. One thing that I'll just mention really quickly with, let me just put this up. Tom Lee said actually something very interesting. And let me just, damn it. It's going to be a minute before I find it, but so I'll play the video after you've done your part. But basically, Oracle is not in the position to be spending every dollar it has on CapEx without any sort of ROI. So this just leads me to believe they're going to be probably one of the first dominoes if we see any sort of pullback on AI spending. It's likely that Oracle is probably going to be the first one to kind of cut back. Another one that's probably likely to start cutting back is, of course, Meta. If Meta's balance sheet cash is starting to dwindle and it's starting to impact their cash flows. So if you look here, Meta forward valuation. So if you see their net income, well, you know what? Net income is probably not a good barometer. Net income, they're just killing it on net income. But right here, cash from operations. So if you look for cash from operations and then you look at repurchase of common shares.
What specifically are you trying to show?
I was trying to show its CapEx, how a lot of its CapEx is being financed by its cash flows, but it's running into the problem that all companies like this run into. They're going to have to eventually cut back on something. So right here is there just it's not coming up. Okay, so if you look here, this is their cash from investing activities. Now I pulled up the wrong.
That's from That's CapEx.
Yeah, I was trying to find cash from operating activities. That's what I wanted to get. Okay, there we go. So you can see here their cash from operating activities has been doing phenomenal, right? But at the same time, look at their CapEx. Their CapEx has been getting absolutely, like, they've been spending a lot of money on CapEx. So you can see that growth in CapEx. But you also see now repurchases of shares starting to go in the other direction. Why? Because
they also have the dividends as well.
Oh yeah, that's true too. So they have to pay that dividend.
And it's small, but you have so many shares and it's such a big company, but so it ends up being.
Yeah, I totally forgot about that. Let me just put the cash on there. Yeah, well, 5 billion. It's small, 5 billion, but it all adds up, right? So 102 billion in operating cash, 52% of it right now is going towards AI spending. And from what Zuckerberg is saying, this is not slowing down next year. So my question is, well, how long can he maintain this level of CapEx spending? And at some point, it's going to have to level off, because what is he going to do? Spend his entire operating cash budget in CapEx? You know, and especially if you're not getting an ROI on it, like Oracle's not getting an ROI on it, then you got yourself like a disaster coming. You know, so I would say next year we'll probably still have some strong AI spending tailwinds, but it's not a bad idea to be a little bit cautious. You know,
Well, that's it's always goes back to what you always have said, right? These semiconductors are cyclical businesses. They have to shrink margins eventually, and you're going to eventually see that come up in Nvidia's price. Because thank you, Melanie, appreciate that. Because you won't, like, you have to think, it's like, well, what are you going to do? Oracle's not going to continue to invest unless they're making money. So in order to make money, you have to play ball. To play ball, you're going to have to shrink your margins, right? So it's just like a chain effect, and eventually it's going to impact the revenue growth of Nvidia. And so it's eventually going to feed down the chain, like you stated. And so this is a domino effect, like you said. And it's why it's a cyclical business, and you always have to be somewhat cautious. And is this the first piece? Did they order too much too fast? Will the demand eventually catch up? You know, will they eventually eat through this? You know, I don't know. You know, but it just always, to me, like, I didn't think that there wasn't demand. That's probably, you know, when you think about it, 100 million in terms of loss, you know, isn't massive. But at the same time, it's like you'd be expecting that they'd be making billions on how much they've ordered. So it's a little bit of a head scratcher.
The one thing is that, look at that depreciation. Depreciation is absolutely exploding. Why? Because these chips, you know, they're good for about 2 years, maybe 3. And then they have a next generation of chips. They have a next generation of architecture. I mean, that's what NVIDIA is banking on, right? Like, everyone is going to keep buying the newest, latest, greatest chip. So, and a lot of these companies probably will. But what happens with all that the old chips now? Like, what do you do with the chips that you bought, the H100s from 2 years ago or 3 years ago? Like, you know, they're not efficient enough to run on new workloads, especially when you compare like the newest Blackwell and stuff like that. So I think this is where a lot of companies, they're really like they really don't want to get into a position where they miss out on AI. So they're spending a lot of money. And I think we're going to be left with a lot of great technology at the end of it. But this is where you kind of have to apply a little bit of George Soros's like mantra: invest into the bubble, you know, invest in the deflationary part of the bubble, and then invest in the reflation where things kind of go back to the mean again. And I think there's going to be a lot of great companies that build their business on top of AI, where there's going to be a tremendous amount of value. Very similar to the .com bubble, right? The .com bubble blew up, but you had like all this infrastructure that was left over that left room for, you know, Microsoft and Amazon and Google and Meta and everything else. So I think AI is going to be very similar to that. So even if the AI bubble, quote unquote, pops and everything goes down, I think among the ashes, there will be the phoenix that rises. So we have to keep our eye on who will be that rising phoenix. So, yeah.
Thank you for the 5 gifted, Ray. You're the man. Much appreciated, brother.
Yep.
Okay, interesting. So where do you want to pivot to next? Do you want to go into cuts? Do you want to go into Verizon? I know you and Steve were chatting back and forth about Verizon today, specifically about how, once again, related to cuts. With cuts, obviously Verizon has a lot of debt on the balance sheet. And then obviously there's the CEO news as well. So I'm curious to see where you want to pivot. I have a video for that as well.
Yeah, I think the first thing is just Verizon. They just got a new CEO who happens to be formerly the CEO of PayPal, Dan Schulman. A lot of people, they took that news as in, oh my God, like Dan Schulman, he's the guy that ran PayPal into the ground, blah, blah, blah. Like it's just a really negative sentiment shift. And because of that negative sentiment shift, the stock took a bit of a tumble. So one of the things that everyone is looking at is PayPal going from its highs in 2021 of 306 to like to this collapse on itself, right? And everyone's like blaming Dan Schulman, like, oh, Dan Schulman was the problem, like he was a bad CEO, like that's why this happened. And I'm looking at this and I'm like looking at his background, and this guy's a really good CEO. He's done a really good job. The problem is, even if you're a good CEO, you've run into this this trap where the market goes absolutely berserk on prices and basically goes like it creates this. Let me just show you guys something real quick. What is it? Their PE ratio, where the market just goes absolutely berserk and is willing to pay crazy high prices for your company. And that's not the CEO's fault that people are willing to pay. What was the PayPal at its peak? It was trading at a 100 PE at the peak, and then people were wondering like, oh, how come the stock went down? Like the CEO must be a terrible CEO. Like, no, he's not a terrible CEO. It's just the market eventually is going to correct on itself. So as an example, like Palantir right now is trading at almost $200 at a 500 PE. Let's say Palantir had a 70-80% correction. Does that mean Alex Karp is a bad CEO? Right? He's the same CEO that took the company from $7 to $200. And that's what Dan Schulman, same thing happened. Dan Schulman became the CEO when PayPal was around, I think, like $30 and took it to $300. But people will remember him for the down move. And it's like, yeah, it's kind of unfair. So if you look at just his Dan Schulman's history, this guy actually has a has a background in telecom, right? So it's not like this guy's just he was known for PayPal, but he's not necessarily just a PayPal guy. Like he began his business career at AT&T, working there for 18 years, became the youngest member of the company's senior executive team. Richard Branson recruited him to be the CEO of Virgin Mobile. Schulman led the company from national launch in 2022 to when it became public in 2027. He became the CEO of PayPal in in 2014, right? Crazy. So everyone will look at the last couple of years and not give him credit for all the other work that he's done here. Like he became the CEO, then he was the CEO of Priceline during his 2 years there. Priceline annual revenues grew from 20 million to 1 billion. So it's not like this guy is a dumb guy that doesn't know how to scale up businesses, So and he's been on the leadership team over at Verizon for a while as well. So like I said, I don't think the reaction to Dan Schulman getting hired as the CEO of Verizon was justified. That negative 5% dip, and so I bought it this morning. And then I looked at all the metrics on Verizon, and they're actually all trending in the right direction. They're what I would expect out of a telecommunications company. So if you just look at their,
I mean, what's the thought here? So, I mean, I'm not trying to cut you off, but I'm trying to direct the conversation to make it a little bit more succinct. I mean, are you doing this as a swing trade? Are you going to be in and out of this within a couple of months? Is this going to be something where you're hoping it doubles, triples? I mean, I just want to give people kind of an idea.
Okay.
So if they're thinking about like, how does this fit into their portfolio, right? Because I always just want to, get people to understand, how this, like, why is this important, right?
So number one is right now there are pockets of market over exuberance, and you want to look for areas where you can hide out and have decent returns while at the same time maintaining capital, right? When shit hits the fan and the market goes down, where are people likely to park their cash? And current macros, like the macro conditions, are deteriorating fast. So if you look at telecommunications like this is a utility like business, right? People, if you lose your job, you're not going to say, yeah, let me go cancel my cell phone plan. I'm going to, you're going to be somewhat defensive about it. We're also in a rate cutting cycle. And if you look at Verizon's like dividends right now, the dividend is really, really attractive. You're getting almost 70 cents a quarter, and they're qualified dividends. So it's a really attractive price to be in. And if you look at the total return on Verizon itself, it's actually been a pretty good returner. So right now, the dividend yield is almost 6.5. So if you get Fed rate cuts, let's say 200 basis points, this means that now people will say, oh, wait a second, I can't just keep my money in money market. Institutions can't just keep their money in treasuries anymore. They're going to be looking for yield. They're going to be yield starved. And what are they going to do? They're going to buy up companies that have strong profile, like liquidity profiles that they can buy into that have really good returns. So right now, even individual investors, like if you have $1 million and you're a married couple and you're looking to, retire and not deal with a lot of the tax simplification, you could buy $1 million worth of Verizon, get $65,000 a year, like my father-in-law, right, and mother-in-law, and they get a nice 6.5% dividend that's qualified, which means almost up to $100,000 of zero freaking taxes for a married couple. Just insane, right? So that's where I'm leaning right now. I'm thinking that a lot of dividend kings are worth investing in, but this one in particular. By the way, they also have a great profile on their dividend growth. So their dividend growth has been pretty steady. So you can see here, every year they've been increasing their dividend ever so slightly, but it becomes very meaningful. And depending on what price that you're buying at, it could rise. And then when you look at the stock price, you can see the way that yields work for companies is, let me just show you the when people are starving for yield, they're going to buy up the stock. And so what happened with last time when yields were, at like ZERP, this was trading at $61. So since then, you've had multiple years of dividend increases, right? So I don't think it's going to get to $60 tomorrow morning, but in terms of like a lot of people looking for good fixed income, this is where you want to be. And this thing could, like me and Steve were talking about, this thing could get to $50. Relatively easily if there's enough rate cuts. And not to mention, you're getting paid to hold it. So, yeah.
Is your thought that they're going to, cut rates so fast that people are going to chase yield and the stock is pretty much just going to inflate because basically their rates are only going to be 2% money market and the only thing that they can buy is something like this, which, at the time when they're inflating the price to say $50 even, it'll still be 4.5-5% yield. Is that what you're kind of thinking?
Yeah. And also the defensive nature of Verizon is good too. So some people in the chat, they're like, oh, you'd be better off buying something like a pharma company that has good dividends. And I'm like, nah, I'm good. Like pharma companies have this like up and down thing. Telecommunications is great because literally the revenues are very stable. Margins can go up and down a little bit. You can see here though, it's a very stable business. And right now, I think people are underestimating just how much stability they actually need in the downturns. So right here, you can see their revenue. Revenue has only been growing, ever so slightly, but in terms of like total return, it's been value accretive for shareholders. So, yeah. So like right now, AI bubble is popping. Well, what is it going to do for Verizon? Not much. I mean, it might be impacted short term, but value investors will jump in on this. The PE on this thing is only, I think, it's 9 right now. And on a forward basis, it might be a little bit lower as well. So, yeah. And they've been paying down a lot of their debt as well. So if you have interest rate cuts combined with debt reduction and like the cost of interest going down, that helps their it helps the bull case a lot for these guys. So where's their long-term debt?
Long-term
Long-term
liabilities.
debt. Yeah, long-term debt right here. So you can see here. Let me just long-term debt. Pay this down.
Yeah, after the Vodafone acquisition, it got pretty
What
rough.
they also bought Charter too, remember? But they needed that. They bought a lot of fiber, and that's the other thing with AI. If you think about AI, you need high bandwidth, you need a lot of you need very little latency, right? So you need fiber. So all of these applications that people are talking about on AI, without the fiber connections going from the data centers to the endpoints, what's the point? You know, you can have the greatest AI model in the world, but if you can't use it, then what's the point, right? So you can see here at the peak in June, the debt was around 150 billion. Now it's about 123. So you know they're working on the debt.
So I
going
pose the
down.
question again, Mr. Patel. I mean, you're posing this as a shorter term, medium term trade, right? I mean, you're not
Yeah,
expecting
I'd
to
say a
hold this
couple of
for
years. I'd say a couple of years for me. For me, it's a couple of years in terms of like both dividend growth, value accretion from people buying into it, and then also I like that it's defensive, right? So if I think the entire market is overvalued, I don't want to be in high beta names. This is very low beta name. Like if you look at the volatility on this, it's very little.
And is that a
So
switch? So is that a switch for you? I mean, I don't see you sitting on a large stockpile of dividend stocks.
no, not right now, but I'm transitioning.
I
Like
mean,
I told you,
I know you have some Brookfield and things
yeah,
like that, the preferreds, because of obviously the interest rates have really hampered some of those things. And obviously, as interest rates kind of reset,
yeah,
the thought process is you know the company kind of writes itself, and the things with that, it's not going to be as hairy for Brookfield as a parent company, and the preferreds will kind of come back closer to par value as they have, right? So I guess my question is you're kind of de-lever in terms of aggressiveness on the growth side and park money here
yeah,
for say the next 2 to 3 years is what I'm hearing, to
yeah.
stabilize the portfolio, get a little bit
Hmm.
more income oriented.
Yeah, and you got to remember, I'm 40 years old. You know, like I need to have more fixed income in my portfolio. Like I run a very, even though it seems like I'm always talking about doing like debit spreads and everything else, a lot of my portfolio is in just yielding assets that are basically just generating me income, right? So my thing is I have a very barbell approach kind of situation where I anytime I have these big wins, I take that money and I just put it into the things that are yielding me money, right? And those yields end up paying for certain things. Like right now, I need guaranteed income. Like right now, let me just give you a scenario. I want to buy a house, right? The current interest rate, about 6.5% on the
Mhm.
interest rate part, right? Now, the thing is, I want to buy a very expensive house because they are expensive right now, but I want to arbitrage it to make sure that I can cover it, even if, let's say, I lose my job. Like, let's say tomorrow I decide, Chris, I don't want to work anymore. How am I going to pay my mortgage? You know, I can't rely on the volatility of the stock market up and down. And basically, my portfolio moves against me. And now I'm struggling to pay my mortgage, right? I don't want to deal with that. So, what do I do? Well, one of the things you can do is put your money in fixed income stuff. Right now, you're getting almost a 6.25%, 6.5% yield on Verizon right now with the dividend increasing. So, buy Verizon, right? Take out a loan like a mortgage, buy this house, interest rates come down, refinance the house at 3%. At the same time, that Verizon stock is going to appreciate and you'll get the dividends paying your mortgage. So,
For now, I
yeah.
think that 3% is wishful thinking. I don't know if we'll see that again.
No.
Uh,
3% is definitely off the table. But like I
yeah.
think interest rates can, like mortgage rates can fall down to probably 4 and 4.25 with the Trump administration really pushing. If things get really bad, we could definitely get back down there. So like right now, I'm looking at a lot of things on the shelter front that are telling me that shelter prices are coming down. You know, so
If we get to the 4.25, then your boy will be buying a house, a nice house. I'll
yeah,
probably retire. I mean, like I'll probably move from Houston and buy my retirement place, and I probably won't move from Houston, but I'll be definitely buying my retirement place.
Yeah.
Yeah.
And the other thing is what people forget about companies like Verizon is that increase in dividend every single, like, so a lot of people, I really had this discussion with my brother. I had to explain it to him. I was talking to him about the Brookfield partners, right? And he's getting a good return from that. But at the same time, I said, you should look into Verizon. He's like, well, Verizon only pays a 7% yield. Why would I want to buy, I mean, a 6.75% yield right now? Why would I want to buy that versus the Brookfields, which are paying more than that? And I said, well, you'll get capital appreciation from Verizon going up. Plus you'll do well on this part. And he's like, yeah, but I also know that I'm not guaranteed 100%, blah, blah, blah. So I had to explain to him, like, well, with companies like Verizon, they have a fixed rate at which they can keep raising their dividend over time. That's their business model, right? Every year they raise prices on consumers, they grow the consumer base, and that dividend keeps growing, growing, and growing. So if you buy at the right time and you give yourself 5 to 10 years of compounding on top of it, your total return profile is amazing. So, he's looking to retire in the next few years because he's done really well for himself, but he's looking for like great places to park his money. And I'm like, right now is a good time to park your money here while interest rates are still somewhat elevated. If interest rates come down, you're gonna be looking for these companies like this, So.
Yeah, I mean, I still am fearful for people that want to look at things that are yielding 6, 7, 8% and think that they're going to be stable long term. I think there's still a lot of hair. I mean, those are companies, generally speaking, and I'm not saying that all of them are going to be bad, right? But generally speaking, those are companies that aren't innovating. Those are companies that are literally in the maturity of themselves and are in harvest mode to return as much capital back to shareholders. I would prefer to be more in the 2.5 to 3.5% range, and being able to be sustainable on living off of 2.5 to 3.5% yield on the portfolio. But granted, as well, I mean, I think if that could be another way that you and your brother look at it is you've accumulated X, right? And you're yielding, let's say, 2.5, 3.5% on your portfolio. And if you're able to supplement, I mean, because you go by the 4%, 3.5, 4% rule, right? I mean, that's generally speaking, if you go, I mean, I'm sure you've heard of that, or if you haven't, for the chat, the 4% rule has been tried and tested in most environments, back tested to say that if you pull out 4% of your portfolio every year over a 30 to 40 year period, you will never run out of money. And there's like a certain amount of time, like 3% or something at the time. It's a very small percentage of the time where you actually do run out of money. So there are certain circumstances over the past 100 years where you would have lost money. But generally speaking, if you had just invested your money in something like an S&P 500, et cetera, and withdrew 4% per annum, you would have been okay. It's more safe to do like a 3.5% per annum. So basically, if you were to take whatever your annual expenses are, multiply it by 33, then you should be okay, right? Is basically what I'm trying to say. So, I mean, maybe that's another way that you can kind of think about it, Chris, is like maybe you don't actually need like an 8% or 7% dividend yield, that might be too aggressive, and you might end up yield chasing, which I see a lot of people doing with these covered call ETFs.
Well, see, that's different though. Like, this is different than the covered call ETFs because this is a real operating business. The covered call ETFs are basically selling volatility to give you that yield, right? Verizon is a real business that generates real income, that pays its debts and has real employees and all the other stuff. So I think Verizon's a different story.
No, I would agree. Yeah. I think Verizon isn't a horrible business, but I think a lot of people, unfortunately, they travel down this rabbit hole where they think they can have their cake and eat it too. And they truly think like, oh, well, if I get a 7-8% yield and get market returns of 7-8%, then I'm getting 15 to 17% annualized. I'm going to be beating the market. And it's just like, yeah, okay, you and everybody else thinks they're doing that too. And in reality, you're not doing that, right?
Well, I'll say this. You have to be very careful when it comes to like what point. Like, so a lot of people just say, Just buy SPY and you'll be fine, right? So let's just look at SPY historically. Just bring this up. If you right now, just let me get a better historical thing of SPY. S&P 500 macro. Okay, this is the annual returns for the S&P 500 by year. Of course, let me just look at the price. Sorry. I just want to see the damn price, man. Okay. So a lot of people will look at this chart and say, wow, I could have just bought the S&P 500 and just, done really, really well, and I would have retired, right? The challenge that you run into is that depending on which period of time that you get in, you can underperform the market pretty substantially for nearly a decade plus. So if you had bought the SPY in June 2020,
Hold on.
I mean, in the year June
Hold
2000.
on.
No, go ahead.
I'm not saying you're starting at, and you're spending 10% of your income a year, right? We're spending 3.5%, right?
Right.
So at most, you're spending 3.5% of whatever your portfolio size is per annum, right?
Right.
So it's going to take 33 years, even if the market stays flat, for you to run out of money.
Oh, no. I'm not talking about your thing. I'm just saying when it comes to the S&P 500, a lot of people, they forget that the entry point is very important. Like when you enter can be the determinant of what your performance is going to be like. A lot of index bros right now are just saying, just buy the S&P 500 index and you'll never have to worry about things ever again. And the thing is, whenever I see that kind of like talk, I get a little bit worried. Right now, I think about 40% of new money is going into these index funds. And the thing is, the valuation on the S&P 500 itself is being concentrated into very few names. That's why I was trying to sign into my X to kind of show this thing that Jim Bianco from JP Morgan put out, which was right now, if you look at the Mag 8, they constitute about 35% of the S&P 500 now. So those companies are the ones that are leading the entire market, which is good because they're cash flow machines. But if anything happens to them, now you're going to see underperformance on the S&P for some period of time. So like it's this kind of the similar thing with the .com bubble. It was around 1400. S&P was around 1400. It kind of went down. It went back up in 2007, went back down again, and you did not recover until 2013. Like you were literally flat for 13 years. And at the same time, you could have been in a name like quote unquote like Verizon and got a 7-8% yield of dividend yield every single year. And now if you look at the total annualized returns at the S&P 500, it's around 7-8%. It's not like crazy like 12-13%, but it is 7-8% compounding, right?
Mm-hmm.
So that's the only thing. So you have to look at like the equity risk premium. And if you look at,
but I don't ever so I don't ever invest all my money at once, Chris. Like
no, of course.
I'm investing twice a month, every month. So
no, I'm not talking about, I'm not talking about you in per se. I'm just saying right now.
But I'm just saying like you're generalizing that somebody's going to invest at the peak of the 2000.com and you're not going to get back to, it's like, hopefully, if people are doing their appropriate work, I think the biggest thing that they can do is contribute that entire time. And they're going to invest, hopefully, in the March of 2009.
Yeah.
And they're going to be buying when it's at 800, and they're going to be able to buy it. And so in that respect, their average isn't going to be the 1500 when it was in, the peak of 2000, 2001. It's going to be, more like 1100 or 1200. And in reality, they're going to have gotten the dividends as well, because the dividends grew during that entire time.
Right. But so, what I mean is it's more so for the person who's like, let's say in there, like my father-in-law, he's 65. He's the only money he's getting outside now is his Social Security. And his Social Security is not going to pay for his lifestyle. Whereas this could pay for a lifestyle plus a Social Security, and you're getting a lot more security, right? So that's why even fund managers, they'll tell you, if you're like in your 60s, you should be in bonds because, you need guaranteed income. Guys like me and you, we're young. You know, if the market takes a 30% crap on us, it's like, whatever. We have jobs, we can keep putting money into the market. For someone who's older, not necessarily the case, you know. And with the markets right now, like if you look at the Schiller PE ratio, it's literally hitting new all-time highs. Well, not all-time highs. It hasn't got to the 2000 peak yet, but it's up there. So right now, all I'm trying to say is right now may not be a bad time to be a little bit more cautious and a little bit more defensive. You know, does that sound reasonable? Sort of.
No, and I agree. I mean, I do think that there's a lot of froth in the market. I do think there's a lot of people, specifically in the crypto area, where I think a lot of people are hopping in. And I don't think that they're understanding the repercussions of hopping in when I still believe, I do believe that there's going to be a peak. I think that we're 20 to 30% from an all-time high in the next 3 to 4 months, or maybe even the next 6 months. But I believe once we get to the second or third quarter of next year, we will be upon a crypto winter. And I don't think that people are acting in accordance of that. I think a lot of people are acting as if, that what they're doing right now is if the party is never going to stop. And I'm afraid that a lot of people right now are jumping in that aren't familiar with or don't have the risk tolerance for that type of investing. And unfortunately, and I've seen this happen in 2017, 2018 during the crypto market. I saw this happen in 2020, 2021. That basically people get in when everything's hot and you can't lose. And when everything retraces 50 to 70%, they exit the market and they don't come back to the market until it's back at it surpasses the previous all-time highs. So, and then they've locked in by that time 50% losses a lot of times, and they're not getting back in and buying throughout the cycle and things like that. And they're really only getting in again. And so it goes back to some of those old adages where it's like, if you're not investing, with time in the market is better than timing the market. If you're not investing in the 10 best days of the year, generally speaking, you're missing out on the majority of the gains for the year. Is because, a lot of times these things, like Tom Lee always says, a V-shaped recovery. A lot of times, it'll dip, like what happened in April. Everyone thought that we were going to zero. And in reality, things turned on a dime, and within a month and a half, we were doing rather well. And I remember everyone thinking that we were going to have a drawdown for the next 6 months to a year. And so, sometimes it's just, caution and and there's times to be there's times to be fast and pull your money out, and and there's reasons for that. But I think a lot of times people act with more emotion. I think a lot of times people think they're smarter than they are. And to me, I'm stupid. I just keep my money in the damn market. I don't try to be smarter than I am, because I'm not smart. I'm the stupidest guy on YouTube, and I'll be the first person to tell you that all the time.
So someone said Jim Bianco doesn't work for JP Morgan. You are absolutely correct. I meant to say the chart that he posted from JP Morgan right here. He posted this like about AI stocks. They make up about 45% of the S&P 500 right now. AI or AI related stocks. I mean, this means that if anything were to happen to the AI trade, you would see a more pronounced downturn. Not to say that it's going to downturn. It's just if 45% of the market is chilling in AI related things, it's you gotta be careful. That's all. And they're like I said, today's move by Oracle just highlights the need for that. And that's why I said one of the places, and I agree with you, I don't think anyone should 100% cold turkey go into cash and just take their money out. And that's one of the reasons why I actually spoke about, rotating into other more defensive sectors like healthcare. That was the whole point of our discussion, which is there are times where there's pockets of opportunity in other sectors. You don't need to be in the highest flying sector all the time, right? Market rotations happen, and when they happen, they happen violently. But you don't have to be there for that. You can say, you know what, let me rotate a little bit of money here, rotate a little bit of money there, and now you can basically, at least de-risk a little bit. So
Yeah, no, I mean, I hear you 100%. And for the people out there that are sitting on 10Ms, congratulations, you've done well in this market. But like, it's for me, I can afford to take the risk. I'm single, I don't have kids. The only thing I'm doing is playing Monopoly. So, I can afford to take on some of these risks. So when I say like I'm not selling Rocket Lab or I'm not selling Palantir, like I can afford to take that risk. Like some of you people out there need to be thinking about college funds, and so the thing that made me most happy, I'm not going to out their name, but I met a gentleman and he had a large amount, more amount of Rocket Lab that I did. I was fortunate to meet him in Virginia when I was able to go to Launch Complex 3 opening. And he said, Matt, thank you. Like, your show gave me conviction and I learned a lot about the company. And he told me how much he had invested and at what price. And he was like, and I took about 2/3 or 3/4 of it off the table and invested in something more stable. I'm keeping the remaining 1/3 or 1/4, whatever it was. I forget what the number exactly what it was now. And I said, congratulations. Congratulations. He won. He won. And he was retiring the next month. That was the goal. The goal wasn't to Diamond Hands Rocket Lab, a company that he had no idea what the hell it was, probably 18 months to 24 months beforehand. The goal of him investing for his entire life was freedom.
Yep.
So I get it. Like you like don't play into these facts of like, oh my God, I don't want people to think like. So if I see people like shaming people like don't sell Rocket Lab, it's just like I'm not selling, but that doesn't mean that you shouldn't sell. I know other people that are selling right now, and I think that's brilliant. Like they have bills to pay. I know people that are going on honeymoons. I know people that are buying houses with it. I know people that are retiring. Like be all beans. Like I'm in a different space, and so I think that you're right, Chris. I think depending upon where you are, you need to think about it. And I think if somebody's sitting on 10Ms and they're sitting on a bunch of risky stocks, and they're 55, 60 years old, and I have this conversation frequently, more frequently than I would like to have, and they're sitting, maybe not 10Ms, but they're sitting on 6 to 15Ms. I have that conversation quite frequently, and I'm like, dude, like you don't have to be this crazy.
Yeah,
you got
turn the risk down.
You could be making a couple $100,000 a year just being calm and sitting on some low key dividend stocks yielding 3-4%. And but that's not fun. Yeah. So it's interesting. It's just like sometimes people become their worst enemy in that respect. But I agree with you, right? And it goes always back to what we always talk about of like time horizon, risk tolerance, objective of your portfolio, how much you adding. You might not be adding, right? That's an important piece as well. Just like what you stated, right? Like important piece. If you're at the top of the market right now and you're going to be adding throughout the next cycle of 10 years, if you think we're going to be flat or go down, etc., very different than if we're at the peak of the market right now and you're thinking about retiring and not adding anymore, right? And also if you're going to be active or passive, right? If you're managing the money, if you want to day trade, etc., or if you don't have any time at all, like if you're working a 9 to 5 and you think you're going to be day trading, well, I got something to tell you. Like you're probably going to be going to the 9 o'clock meeting and you're going to be day trading that stock. And unfortunately, Bill from accounting is going to ask you what your thoughts are and you're going to miss the trade. So, I've tried to do it, I'm telling it from experience, right? I've tried day trading while working at a 9 to 5 and it never worked. And I've tried doing all these things. I've missed out on hundreds of thousands of dollars of opportunities because of the mistakes that I've made. And so I hope that comes through. And, these banks aren't necessarily stupid when they say, take these 5 things for kind of what they're kind of worth. So
I think the part that in this market that's a little bit, it's a little, I wouldn't say pissing me off, but it does upset me a little bit, where people are like, Buffett is an old fool. He doesn't know what he's doing. Like he's missed this AI run completely. And then Peter Lynch was on the thing with Josh Brown, and basically he's like, look, I didn't even know how to say NVIDIA 6 months ago. And they were giving him shit like, oh, this guy, one of the greatest investors of all time, completely missed out on Nvidia. Like, what does he know? And all these, like, I see so much retail be like, oh, the hedge funds are stupid. And, and some hedge funds are stupid, don't get me wrong. But they're literally shitting on a lot of like investors who have a proven track record, not over a cycle, but over multiple decades of investing. And so when people are like, I'm smarter than Warren Buffett, I'm like, yeah, okay, man, that's usually a pretty bad sign, Like it's just something that to consider. So whenever I see any post, they're like, oh, old man Buffett doesn't know what he's doing anymore. He's too old. Okay. If that's what you think.
Papa Buffett.
Yeah.
So when are these cuts? Is it next week? Is it 2 weeks from now? I forget.
Let me pull up the CME group. Let me see.
15th? It's been a minute since I looked, and then we'll finish off with the portfolio.
Get some sleep, man. You're really grumpy today. This is not the happy-go-lucky Matt I know, man.
I'm a grumpy boy.
What happened? Did something happen, man? You could tell me. I'm your friend. Let's see. So probabilities. Let's see the dot plot chart. Ugh, not this one. Damn it. Okay, so October 29th is when we're likely. Yeah, October 29th. Right now, everyone's leaning towards a cut. Right now, it's 4 and 4.25, like 4 and 4.25 right now. So everyone is leaning towards a cut. So probability. So Fed meeting October 29th, and then the one after that is December. So
yeah, I was gonna say
everyone is
November.
Yeah, everyone's leaning towards another cut in December, and then of course there's January, and people are leaning towards. I think they're leaning towards just keeping it the same, but there actually are more people saying that we could get another cut in January, and then March. Oh, there's actually some pickup too. Look at this trend. Well, actually went down and then went back up a little bit. So I guess we'll see what happens, but at least 2 more rate cuts for the year is what the market is baking in right now. Unless some kind of crazy inflation data comes out that says things to the contrary. But as far as I can see, the economic data is just pointing towards a deflationary environment coming. And I think next year we'll probably get another like 4 or 5 cuts. Like next year, the current projections are interest rates would bottom out or about 300 basis points, which is what majority of the people are thinking. So if you think about the 10-year, usually about 150 to 200 basis points higher. So the 10-year is like probably like the same, I guess. That's why the market is not really moving that 10-year so much. And if the 10-year doesn't move, then mortgage rates aren't exactly going to come down next year, which means housing is probably going to be in a bit of a pickle. Yeah, I don't know. This is why what's his name? Stephen Mirren. He was the lone guy. Like you see this little dot right here about where the interest rate should be. He's thinking right here. Which was kind of crazy, right? But I actually agree with him. I think the interest rate should be lower because if we do get some sort of massive like hit economically, you want to preempt it before we get there. So, yeah, I think this is.
Yeah, I think we raised too high. We raised too high. I don't know. It's tough because everything's still running to an extent, but at the same time, there's some underlying data. It's tough.
Well, I think so. There were structural things that the Biden administration did that made this thing even worse, which was one, we already had inflation and they did that stupid Inflation Reduction Act, which did nothing but add more liquidity to the fire. And then you had all these COVID era programs where people were just chilling. Like you had student loan forbearance extended over almost 4 years where people don't have to pay their student loans. Well, now they do. And what's happening? People are defaulting at crazy rates. Then there was like a moratorium on housing, if you remember, where you couldn't evict anyone, right? A lot of blue states had that BS happen. So a lot of that inventory is out there. And then you had mortgage. They did something called workouts, where basically a lot of people, they would just let you work out your mortgage and put the dollar amount to the back end of your mortgage. So there's a lot of loan modifications there too. So it's a lot of games that were played during the last 4 years under the Biden administration that really made inflation worse, So I think the trigger, of course, was the Russian invasion of Ukraine, which spiked energy prices. But I think the Biden administration kept those inflation where it was from all that unnecessary additional liquidity support. So, yeah,
interesting. So let's run through the portfolio really quickly. We're selling at about 12,600, which is a pretty impressive. I don't know when this last snapshot was here, but it was 11.4. I don't know when this was. I'll have to go back and check. But 12,600. We have about $3,000 in cash. I think we sold out of UNH. That was like a week and a half, 2 weeks ago. We haven't really bought anything since then. Chris has told me to buy a couple things, and I've just been dragging my feet. But overall, market's been pretty kind to us other than next decade. I think this is just a liquidity thing. I don't think this is real because, as you know,
no, it's not.
Yeah, VG is down, right? So I think this is just because somebody probably put the bid ask at 75, and so it's probably just the spread. But that happens pretty regularly because VG is pretty low liquidity. So,
well, that's the thing. The one thing I hate about Fidelity is that they have this stupid thing where unless it's like Fidelity, if you look at your account at 3:31 in the morning, if you have options, your account balance will change materially. Why? Yeah. Because everything that they record, they take the lowest bid and the highest ask, and they use that as a mark to market. So if the spread between the two is relatively like high, then it kind of gives you this false like presentation of what your actual account performance is. So like sometimes I'll look at my portfolio and my stock, the one that I have, or my option position will be up like 10%. The stock is up 10%. But if I look at my account, it's like, you're down 50,000. I'm like, how is that? Like, what is this? And then you look at it and it's like, oh, that's why, because the stupid thing is looking at the bid ask, and it's using the lower amount. So
yeah, no, I get calls from people, especially about VG. They're like, "Oh my god, like, am I doing something stupid? Like, did I mess up?" And I'm like, "Calm down. I'm looking at it literally on Robinhood. You're fine. Like, you're good." So anyway, VG, we're doing well, up 36%. We got a nice dividend. Did we already get the dividend? I forget. I think we did. Next decade, we're still down a little bit from this one. Our cost base is about $8 or so. So nothing too shabby about that. We just haven't added shares in a while. So obviously with the price retracement, these two are doing relatively well. Our space stocks, Rocket Lab and ASTS. So yeah, those are doing relatively well there. BPYPM, I think these two paid us a dividend over the past week, so that added to our cash pile. But even still, the capital appreciation is 9%, so still getting a decent dividend in the, I think, double digits, as well as a decent capital appreciation. Oscar, as Chris alluded to earlier, these healthcare stocks are starting to show up favorably for the year. BPYPN, we just talked about BPYPM, decent dividend yield and dividend payment for the quarter, coupled with the price appreciation. Bitcoin showing up pretty well. I like BTC for anybody that's holding long term, that doesn't care about liquidity, selling covered calls, or anything like that. BTC is the lowest expense ratio. So if you want an ETF, you don't want to worry about buying, actual Bitcoin, and just want to use an ETF to make it simplest, then that's it. Interesting fact for anybody that's listening, somebody shared with me that the IBIT ETF is now the most profitable in terms of revenue generation for BlackRock. So it generates over $300 million, over like $350 million in revenue for BlackRock, which I thought was pretty interesting because it's, what is it? It's over 180 billion under management, and it's a 0.25% expense ratio. So it's a lot of assets under management, and it's a very small expense ratio, but it all adds up, right?
Yeah.
We have Norwegian Cruise, 42%, ABCL, 35%, and then we have our VG call, which I think we're pretty safe. We have next Friday at 17. So just for $20, 2 covered calls at, I think we pocketed 10 cents a piece. So nothing too crazy there.
Yes, sir.
Any guesses on how we returned over the last year, or for the year to date and trailing 12 months?
35, 40%.
Come on, man. You know we're better than that.
Yeah, I got it. 40%. There you go.
45% year to date, and trailing 12-month 55%.
Nice.
Not including today. We were down today because of VG. So,
all right, it happens. But then again, this could be an opportunity to add to our VG position if it gets low enough.
Could be.
You know, because they did release an 8K that they did 100 cargoes last quarter or last month. I have to look. But dude, their run rate, they're gonna be doing how many cargoes a year right now? I just looked. I think they're gonna do about 300 a quarter. Let me see. Hold on. Just look it up.
300 a quarter. That's pretty wild. Yeah, Doug shared that. Sorry to name drop you there, Dougie, but he shared basically they shared their. Do you want me to tell me when to share? I don't want to show any proprietary stuff. The liquefaction fees that they got, and so yeah, it wasn't too off for Calcasieu Pass, but it was slightly lower for Plaquemines. But Chris, I've been doing some looking on what the long-term EBITDA is for this thing, and man, this thing, man, I'm curious to see how we do. I mean, if we end up being able to refinance some of this debt and get a favorable interest rate for some of it, then this thing's going to be printing. I mean, plus coupled with share buybacks. I mean, you and I were talking. It's going to look pretty interesting with respect to it's almost like a bank, right? And I want to do some quick calculations because, like, if these guys continue to execute the way that they are by mid 2035, mid 2030s, 2035 timeframe, they'll have a lot of facilities online and expansions, and they're going to be exporting a lot of gas, and a lot of it's fixed toll, as we've kind of alluded to. And, we don't have to go down that rabbit hole per se, but it just looks interesting. And like you were saying pretty much earlier today, one of my voice notes back and forth with you, potential share buybacks and a lot of other things that could really increase the opportunity set, the price appreciation for it. So that'll be interesting. I mean, it's how do I say this? It's one of those things. I need to do some quick math to be like, okay, it's a blank X over 10 years. And then if you buy back X percentage of the shares, then that could increase your returns by X. But then you have to think about, okay, you could say 100% return, and you're like, oh my God, 100% return. But if you say 100% return over a year, impressive. You say 100% over 2 years, that's 40% annualized. You say 100% over 3 years, that's only 25% annualized, right? So you have to think like 100% return or 200% return over the length of time is very important to understand, because a 3X or 4X or 5X if it's over 15 years, really isn't that impressive, right? So it really just depends upon, are we talking like 5 years, 10 years, 15? And so that's what's important. And I think the thing that's nice about this is, to me, it's going to be steady, and hopefully delivery is going to be consistent. And so I think it's not going to be something where I feel like you're going to see an S curve, which could be good or bad depending on what you're looking at. But I think if you're into something where you want to keep track, I mean, this is one of those companies where I think you'll be able to keep track progress wise on a month in, or not a month in, quarterly or semi-annual basis, and be like, okay, how's progress? Is it on track? And, if you kind of know what you're talking about or what's going on, then you might be like, okay, I feel like this is in the right path or not. But maybe that's easy for me because I understand it a pretty good bit. So anyway, were you going to share?
Yeah, I was just going to share. 1 second. Sorry. There you go. No, they're just, if you just look at like the trends that they have right now. So let me just go to their. So Calcasieu Pass right now is running about 38 cargoes a quarter, right? So they're not, I wouldn't say max, but that's what their theoretical limit is. It can do 40, but let's just say 38, right? 38 multiplied by 12, and so 38 times 12, you're looking at about 456 cargoes a year coming out of Calcasieu. And then according to estimates for Plaquemines, it looks like it's going to be tapped around between 88.96, and then Q1 is 88.96 as well. And I think that's when the first two phases are pretty much all done with. So you're looking at about 90, right? So 90 times 4, about 360. And how many did I say from Calcasieu?
30 something, I thought.
Let me see.
Scroll up.
40 times 40 times 160, right? So plus 160. So you're looking at per quarter. No, I'm doing this right. Oh. No, I'm not doing that right. So let me do this 1 second. So let's do 9. Let's just keep it even. 90 times 4. So 360 cargoes from
Plaquemines,
right? And then this one is 40 times 4. So 160. So it's 160 plus 360. So you look at, 160 plus 360. 520 cargoes per year. It's freaking crazy. 520 cargoes. I'm trying to figure out like what the EBITDA on this thing is going to be, but it's hard to know because of the spot prices, because they have so much in spot that it's really hard to determine, because you can see here a lot of their stuff is still uncontracted.
Yeah, I generally just estimate things on a contracted basis and just assume. Yeah. But you're right. I mean, obviously it makes a big difference, right? You can see the weighted average liquefaction fee is $7 for the ramping up facility versus the Calcasieu.
$2. Yeah, it's $2 for Calcasieu right now. So like I said, it'll be interesting. I've got to run the model again and just get a calculation on what it's going to be, because eventually when these things do go into what is it called?
But CP2 is big, man. CP2 alone, CP2 phase 1 alone is as big as Plaquemines. So
do you remember when their first date is for CP2? Because they already started the construction. They're moving fast.
Yeah, I just updated my table. Maybe I'll share that. Where the hell is it? I'll share that with everybody in case, because it's been a while since I shared it. Show everybody how wild the scope of projects is. So, and ignore the spot contracts piece. I haven't updated that piece, but everything else is updated. So you have Calcasieu project, the first piece, it's operating, that's up to 12 points. It's actually probably up to closer to 13, 14, but we'll just say 12.4 now. The Plaquemines, that's up to pretty much up to 20. They're ramping it up to 28, hopefully, fingers crossed. And then you have the phase one that was just sanctioned. So they sanctioned that in July. They said at the moment commissioning is end of 27. So basically, when we're supposed to start seeing gas from next decade, trains 1 through 3, we're going to start seeing gas potentially from CP2 phase 1. And so
You
that
said
would mean
next decade. You meant Venture Global, right?
no. I mean, same time, right? I mean, next decade.
Okay, gotcha.
Trains 1 through 3 will be coming online at the same time as
That's right. You're right.
Yeah. So hopefully, we'll hopefully be seeing both of them for people that are following along. We own both in the portfolio. So sorry, I didn't mean to combine and confuse anybody, but yes, the hope is that both of these new facilities come online at roughly the same time. Then there's phase 2, which they stated is hopefully in the next year. They're going to sanction by mid 26, and I just assume that that's going to be $7.5 billion. So roughly, it's going to be $22 billion, about a little bit about what they did for the Plaquemines project. So that'll be slightly bigger though, and then that'll be online in 2030. But then you have Plaquemines expansion. They have that. That's supposed to be sanctioned in 27. So they have details on that. That'll be 2031 startup. And then they don't have details on this, but this is my assumption. So you have CP3. That's hopefully also mid 27. But even if it's not, if it's 2028, that's going to be, a huge project. That's the big boy. I mean, that's 48 trains comparatively to everything else. I mean, Plaquemines is 36. This is 48. So very big. And then Delta, they removed this, I think, just so they could expand this faster. Because you could see it's like, oh, do we want to do the Delta project out in 2029, or do we want to do an expansion project in 27? It's like, well, this is going to get you EBITDA faster, and it's also going to be brownfield. So it's probably going to be, higher return than doing a greenfield development. So you're going to get 26 MTP out faster than 34 by 2 years, right? So if you think about it, it makes sense to potentially pause this or take it off the list, put this Plaquemines expansion ahead. So at the moment, that's what it's looking like. Now, I don't know. I mean, it seems aggressive, but this is what they've done so far, right? August 2019 to March 2025, May 2022, literally May 2022 to December 2024. So it's literally sanctioned it, and 2.5 years later they were producing. So, and then same thing with this, August 2019 to March 2022, like 2.5 years later they were producing. So that's literally what they're predicting for CP2. And we know that they're literally already put $5 billion worth of capital into this project. So they're pretty much already getting everything ready to go. And they said that pretty much the first train, I wouldn't be surprised in the 3Q earnings call if they say that the first train has already arrived on CP2 grounds. So let me know if you want me to share your screen.
Yeah, no, I'm trying to find something if I can see the latest update that they have, but I don't see it. Yeah, I think the biggest thing is debt, man. If interest rates come down, this will be very value accretive for them because they can keep those expansions going without relying too much on their. I mean, that means that more of their cash flows can go into servicing that debt and also being able to take on more of these projects. Like one of the reasons why you have such a valuation drag on Venture Global is just the sheer amount of debt that they have relative to their EBITDA. So they have to stabilize that debt. You don't want a situation where your debt is outpacing your EBITDA so much that now you're kind of like running on the back foot. And then you have to sacrifice future growth in order to just keep things going. So right now they're in a good place. One of the strategies that they do, and I think a lot of people don't know, is they have something called capitalization cost that they roll into the project so that this way you can depreciate it, right? So right now, let's say you spend $20 billion on a project, you're not going to, you know, you're going to borrow money and like it's going to take you 2.5, 3 years to construct that. Well, the money that you borrowed, if you're paying, let's say 10% on it, right? That's going to be about $2 billion a year. So that's $4 billion on top of cost. So if you had a project that's 20 billion, it's actually going to cost you 24 billion. So what do you do with that other 4 billion that you had to pay in interest? Well, you take that money, you put it into the cost and say you have a $24 billion project. The thing is, and you depreciate against that 24 billion, not the 20 billion, which is good for tax purposes. But if interest rates come down, that means future capital, you can borrow at a cheaper price. And if you can borrow at a cheaper price, that means that now your margins are going to expand. So right now, debt servicing is something that they're going to have to focus on, I think, in 2028 and above to make sure that they're, there. But in my opinion, by that time, they'll be at around 8 billion in EBITDA. And if we get another sort of a spike in what is it called? In natural gas prices, that could be super value accretive. I mean, look at what happened to Cheniere. Cheniere had some excess capacity during the Russian and Ukraine invasion, and natural gas spiked, and they were just making money hand over fist. And they were able to pay off a lot of debt at the time. So, a very similar thing could happen at some point with Venture Global, where they have excess spot cargoes. And if something happens and oil prices spike, because I mean, you know how natural gas is. Natural gas is volatile. Something happens, natural gas prices spike. Now you've got futures contracts that absolutely explode, and you can take advantage of that. So if something like that comes along, then yeah, it might be a good time to basically contract all those cargoes and use that excess cash flow to pay down that debt, which means you're going to have value accretion to shareholders. So, but
yeah,
you can't rely on that. Yeah.
One of the things I was telling you the other day, and I wanted to at least get it off my chest while you were talking about it, was depreciation. And speaking of, is you brought it up specifically for Oracle, but it's a huge piece for Amazon, because you think about how many warehouses, trucks, robots, etc. Even the chips and everything that they have for their cloud business, like all of that, you have to think how much they depreciate. So I think a lot of times when people might be looking at EPS growth or something like that, it might be a drag comparatively to, like, let's say a Google, when in reality, if you look at the cash flow from operations, it's really not too far behind Google. And so when you think about it on a price to cash flow from operations basis, Amazon's actually not much cheaper, but actually at a pretty decent discount, like by 10%, 15% comparatively to Google. And so it's interesting to kind of see it from that perspective, because the net income truly gets whacked because of the depreciation expense that Amazon has to go through. And so it just goes to show you, like, you can't always be trusting the GAAP EPS that some of these things have, because like Chris said, they're giving you the depreciation to help with your tax expense, right? That is, it's like real estate, right? They're giving you that to be able to assist with your taxes. So think about it in that respect. So sometimes it's best to evaluate some of these businesses, especially the cash intensive ones, on a cash from operations perspective, because that's like actual cash in the door, right? You actually know from a cash in the door perspective what you're receiving on the balance sheet as cash. And that's what, to me, is more important sometimes than the actual net income. Well, the net income is still expensive as well, because obviously, you need to kind of keep some of that stuff in perspective. But sometimes it's literally just pushed down because of the depreciation. And real estate.
What's going on with the chat today, dude? Everyone's talking about life choices and which schools they need to go to, and like whether they should go to college or not.
I don't know. What are you thinking?
I'm just looking at some of these things, and I'm just like, I think everyone's tuned out of our conversation and more people are focusing on the chat now.
There you go.
You guys don't read the chat. That's why.
Heard it here first.
All right.
Heard it here first. Well, appreciate the 260 of you jumping in today and putting up with my shenanigans, Mr. Patel. Anything you want to say before we hop off?
No, I think we just need to pump the brakes a little bit on AI. Don't go too crazy with it. I don't think there's a problem with AI. But I would say, depending on where you are in your age group and where you are in terms of close to retiring, whatever, if you've done well in this market, you need to be a lot more prudent with where you allocate your capital. For the young cats like the Amits of the world, they are 20. They have 40 years to go. They can be a lot more risk on and go right to the edge before they have to pull back. You do not have that same luxury. You do not have that option. So if you're really old, and you need this money to basically live and survive, right now you should be considering just being a little bit risk averse.
Mm-hmm.
On the other hand, if you're 20 something and you think you have the guts and the will to power this market, by all means, go right up to the edge. But yeah, in terms of risk, it's also numbers. It's an age thing. There's plenty of opportunities right now to get into fixed income that I think are, for someone who's older, it makes a lot of sense. Like I said, for my father-in-law, dude, with a 7% dividend yield every year, he's golden. He can live a really good life, a 7% return a year, plus some capital appreciation along the way from the appreciation on the stock. He's going to be golden. So right now, when I structure a portfolio, because I work with him to structure it, he missed the AI bubble. He missed the AI trade completely. But you know what else he had? He slept really well at night. So, and he's
Sometimes that's more important.
Yeah, and he's worked his entire life. He sold his stores. He's at a point in life where he needs fixed income. So if you're in that age group right now, is not a bad time to, spread the money around a little bit. But if you're in your 20s and, like I said, you want to go to the edge, by all means, go to the edge.
Yep. Very good. Well said, Mr. Patel. All right.
Yeah.
We will see. We will check in on Thursday, and hopefully we will see you guys then. Talk to you guys then. Cheers.
Yep. Have a good one. Take care.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Or look at it say, it's beautiful!
Welcome to the fucking show.